Let's start with a brief review of some basics. What is right versus obligation? Here's a reminder of who has rights and who has obligations. For example, looking at our matrix here, a buyer of a call has the right to buy an underlying security at the strike price at any time before expiration. So with this in mind, let's take a look at our first example, trading a long call. One of the most common option strategies is buying a call option on a stock. By purchasing call options, investors can reduce the downside risk of owning a stock, gain leverage, and diversify. Many investors like buying call options as they require little upfront capital and will follow closely the price of the stock. Let's look closely at this bullish strategy. The strategy consists of buying a call option. Buying a call is for investors who want a chance to participate in the underlying stock's expected appreciation during the term or expiration of the option. If the assumption is correct and the stock does move up, the investor will be able to sell the call at a profit at some point before expiration. Market outlook. A call buyer is definitely bullish in the near term, or at least during the life of the options contract. Profiting from the growth of the stock price and the small cash outlay are among the main motivators in the strategy. Let's walk through the steps in setting up a long call. Since the main driver of your option is the stock price, you must carefully select a stock you feel bullish about. In the example below, we chose Facebook, which is at $107.50. Let's assume that we expect the stock price to appreciate and recover back to $115. If the stock price moves as planned in the short run, you can sell back the option ahead of expiration date. It's always a good idea to have more time left in the contract than to run out of time and not give a chance for the stock price to move your way. So if you believe that in 2 to 3 weeks the shares of Facebook will reach $115, you may look at an option with expiration of at least 30 days. There are variations of selecting a strike price. Many novice investors tend to purchase calls with strike prices that are out of the money. OTM are cheaper compared to the in-the-money options. The cheaper the option, the more leverage it will have, and the more erratic the movements will be. In our example, we'll use the 15th 105 call as a more conservative use of leverage. The cost of the premium to own it is $5.30 per contract times 100 shares for a total investment of $530. The price point at which the investor will not make nor lose money is referred to as break-even. Strike price plus option premium cost equals break-even point, or $105 plus $5.30 equals $110.30, which is the break-even point in the Facebook example. The maximum gain, or MG, for a call option in theory is unlimited. Shares of Facebook could appreciate to infinity. However, to realise the gains, you'll need to sell the option before it expires. Some investors will set themselves a target of 30 to 50% return on investment. While the maximum gain could be unlimited, the maximum loss, or ML, of the call option is limited to the premium paid. In the preceding example, the premium is $530 for purchasing the call. The y-axis of the graph shows the profit-loss of the call, while the x-axis indicates the stock price and the break-even point at $110.30. As a buyer of a call option, you have the right to exercise the contract and purchase 100 shares of Facebook at any time on or before the expiration date. To do so, you must notify your broker. The risk of assignment is non-existent in a long call. Buying a call option could be a speculative activity. This is because we think the stock price will rise. Take time to familiarise yourself with the stock's direction before purchasing a call as a substitute to a stock. Other steps that novice investors and traders can take to manage the risk more effectively include careful selection of expiration and strike price. Options that have more time to expire will decay or devalue slower, while options that have more value, typically deeper ITM options, will move more in line with the stock price. A put option is a contract that gives the buyer the right, but not the obligation, to sell a stock at a certain price. As in a long call, a long put also has a directional bias, but here we expect the underlying stock price to fall. The put option will appreciate in value as the underlying shares decline. An investor is looking for a sharp decline in the underlying stock's price during the term of the option. Aside from capitalizing on bearish market moves, investors also buy put options to protect their portfolios or individual stock positions against bearish markets. Let's look at purchasing a put. The steps to purchasing a put option are similar to the long call strategy, but reversed. First, we study the movements of the price over the last 9 months. In this example, we'll use the share of Goldman Sachs Inc. The general direction of the underlying stock has been mostly down, and we are comfortable that the trend will continue in the near future. Our first step is to choose the expiration month in our long put. The selection of a strike price depends also on how quickly you expect the price to fall or how aggressive you want to be. Just as in a long call, a more conservative approach to buying a put option will be to select 1 or 2 strike prices in the money. For the above example, we'll select a strike price of $155. To calculate where the strategy breaks even, you must take into consideration the strike price of $155 and the premium or ask price of $8.60. After subtracting the cost for the put option from the strike price, you arrive at the point of breaking even at expiration. That's strike price minus the premium, which equals the break-even point, or $155 minus $8.60, which equals $146.40. The maximum gain of the put option could be substantial if the stock price falls quickly over a short period of time. Still, the gain is not unlimited but capped, as the stock can only fall down to 0 before becoming worthless. After the stock has moved to your target level, the earlier you sell the put option, the more money you'll be able to receive back for it. The maximum loss of the contract is limited to the initial investment of $8.60. It's important to note that investors do not have to take maximum loss if they find out that the strategy isn't working out as planned. They can sell back the contract early instead of losing the entire investment. Just like calls, as a holder of put options, you have the right to exercise the contract at any time before expiration. When the option is exercised, you have the right to sell at $155. In so doing, you'll have a short position of 100 shares. This is why most investors will choose to close or sell the put option well before expiration. The risk of assignment is non-existent, as the owner of the put option is in control. For holders of long put options, the benefit could be substantial. as long as a drop in the price of the stock takes place. It's therefore a bearish strategy. To manage the trade properly, investors need to allow enough time and consider buying options that will follow the stock price more closely. Options that are more sensitive to the stock price movement are in the money. You may recall that ITM options are those whose strike price is above the stock price.